Hello again from Core Wealth. We are covering the first month of the second quarter of 2023, April, and we'll have a look at what's happened in the markets and some of our thoughts for the year ahead. So if we have a look at some of the main headlines globally during the month, the first one was on the side of the oil price. We saw that spiking up as OPEC, which controls most of the oil supply globally, announced that it was going to cut back on the amount of oil production it was releasing into the market. We saw the oil price go up to over $85 a barrel during the month of April. The other thing that was good to see is that the reopening of China post their second COVID lockdown is starting to see that economy growing quite strongly, and they posted a trade surplus of $88 billion, which is double what it was for the same period a year ago, and this was looking at March data. Then lastly, the question around inflation. We've seen early indications of economic growth in the UK and in the US, but there is a concern that inflation is still going to be too high. The services sector has been growing quite strongly, but inflation remains a concern, and we expect the Fed to raise rates again at their next meeting. So in the South African headlines during the month, we saw load shedding dominating that. Continues to be a drag on economic growth, but we spoke a lot about that outlook in last month's monthly wrap-up. Then on the other side was food inflation and energy inflation, stopping our inflation numbers coming down as soon as we would like, but we don't think are going to have a long-term effect on inflation. Then on a positive note was the February trade numbers came out, so how much we are dealing with the rest of the world, how much are we exporting versus what we import, and we had a trade surplus on the back of increased vehicle sales to the rest of the world of some 16 billion rand compared to a 22 billion rand deficit in January of this year. So that was some good news, and really what we want to see more and more of is trading where we are selling more to the rest of the world than we're importing. So despite some tough headlines around the world, we saw markets responding, almost all of them positively for the month. And you can see the global equity markets, developed markets up almost 5%, the South African equity markets up almost 3.5%. And then listed property, both locally and globally, was up over 5%. And the only place where there was some negative on this chart was the South African bond market for the month. If we look at the year-to-date numbers, quite a strong start to the year, up almost 9% for the South African equity market, and global equities, because of the weakening in the rand that we've seen, up almost 18% on the developed market front and almost 11% on the emerging market front. So if we have a look at the 3 years and longer periods, growth assets, particularly equities, have rewarded you. So developed market equities over 3 years giving you almost 13, compared to the South African market giving you just over 20 for that same period. And then longer term, South African market hovering around 10-11%, and international markets between sort of 13 and almost 17% in equities for each of them. Some good returns as well from global property markets, giving you close to or 10% per year over the 10-year period. The rand over the last 3 years has actually strengthened slightly against the dollar and the pound specifically, but over longer periods of time has weakened by between 2.9 and 6.1% over the 15-year period. So just emphasizing the benefit of having growth assets both locally and internationally, and getting a bit of an additional tailwind internationally from the currency. So the strong markets in April drove some good absolute returns during the month, and continued to add to the portfolio's outperformances of their peers. So as you would probably recall, the relative return shows how much we've outperformed the peer group average, and we can see over the last year some strong outperformance and even better figures over the last 3 years, where the absolute returns now on something like our flex strategy over 17%. So equities really rewarding over this 3-year period. And then the longer term numbers, the 5-year numbers, is a new column that we've added in. On the whole, a reasonable picture. And then the since inception numbers, where most of these strategies have got more than a 10-year time horizon now, show some consistent outperformance of the peer group, with the right hand column all being green. So if we have a look at our international strategies, so this one is our US dollar-based strategy, we can see again quite a pleasing picture. Although the absolute returns for the month are a lot lower because they're in dollars, the consistent picture of good outperformance of the peer group comes through here. And if we look at the since inception performance, again, a 6.4% return on our global growth strategy in US dollars is quite an attractive return and some healthy outperformance of its peer group. And this is over the last 6.5 years now. So lastly, if we have a look at our UK sterling global strategies for clients who are either based in the UK or who have a bias towards having returns in pounds, this is our youngest strategy, so only started in November 2021, but getting some good outperformance both over the last year and since its inception. Although the absolute returns are negative, that is just because it started in a period where just before we saw global markets really taking a lot of strain in 2022. But the outperformance is something we're very pleased with for those clients. So a big question is the US going to slow down? Is their economy going to slow down and go into recession? This slide from the US Fed just shows you that currently the purple line, which is an indicator of whether recession is going to happen in the next 12 months, is saying there's a 68% probability of that happening. And you can see the last time it was this low was back in the early 80s. And then the gray areas just show you when the US actually went into recession. And you can see every time this line has got really high, that a recession has followed shortly thereafter. And so this for us is a concern that the US economy will slow down. This is another graph. You can read it more in the wrap up, a lot more technical, but essentially saying the same thing. The warning signals are the black and the red lines, saying that the economy or the data is giving a warning that the economy is going to slow down. And so the leading economic indicator over the next 6 months is to see negative growth in the US economy. So let's have a look at valuations on the S&P 500, the largest companies in the US. And this table just shows that the current, if we look based on the expected next year's earnings, we can see that the US stock market is still expensive compared to its 10-year average, which is the dotted blue line. The 5-year is slightly cheaper than the 5-year average, but the 10-year one is probably more important in our view. And then if we have a look at earnings expectations, earnings are only expected to grow by 1% over this 2023 year compared to last year. So nothing really to get too excited about in terms of earnings growth. So if we have a look at what has driven the US stock market during this period, it's a very interesting picture. As this graph shows, it takes the S&P 500, so the largest 500 stocks in the US, and they've given you a return of just over 5% for the year to date. And if you compare that, that's the black line. But if you compare that by how much of that return was driven by your typical FANG stocks and 3 other stocks, you can see the list of them at the bottom left of this chart. But more than the total return of the S&P 500 has come from just those few stocks. The rest of the market, which is over 490 shares, have actually negatively contributed to that total return. So very, very few shares driving the total return of the market. Then secondly, if we have a look at, well, what have been the big stocks the big winners, and what have they been involved in? This chart just shows you again since the beginning of January that stocks that are driven or that are involved in large language models or your typical AI, things like ChatGPT, how have they performed? And there's been over 1.4 trillion dollars worth of value has been created by companies or in companies that have been involved in this type of artificial intelligence. So you can see the bright red line, that is companies Microsoft, Google, Amazon. You can read the names there. Then other tech stocks. The other 5 largest stocks that drove the market is the darker red line. And then if you take the next from the 11th to the 50th stock in the S&P 500, the green line much lower, and then the broader market basically slightly negative for this period. So not only was it a few stocks, it was a few stocks that were involved in one particular type of industry. So having spoken about how narrow the market is, let's just push that point home with these last two slides. The orange line here just shows you the weight of the largest 10 stocks in the S&P 500 through time, and we can see at around the period of the dot-com bubble, you can see that they became a large proportion. The graph shot up during the TMT bubble, and again to some degree during the global financial crisis. But at the moment, they are way, way higher than they've ever been. If we look, the blue line shows the next 40 stocks in that index, and you can see how that has got lower and lower. So basically, at the moment, we have a far higher concentration in the top 10 stocks than ever before. And then this graph really just shows you, looking, the gray line or the gray area of this graph shows you the largest two shares in the S&P 500. Currently they make up 13.4%. The largest single share actually makes up more than half of that and is over 7% of the index. But what's important is how high this is relative to any time in history. So the market is extremely concentrated, and that we believe does pose risks for investors if you're not well enough diversified. So that's a lot to take in. US economy, we expect to slow down and go into recession. This could have a negative effect on particularly quite concentrated portfolios in the US. However, we've done a lot of research, can't go through it now for time's sake, but just looking at what types of strategies do the best through economic recessions. And it's typically your more quality focused investment managers, and those are where they're looking for companies that can do well even though the economy is slowing down. And we have exposure to a number of these both in our local South African models as well as our global strategies in the UK and the US dollar version. So while there may be some tough times ahead, we continue to remain invested with our client strategies, because it's by being invested over the longer term that one achieves the results. Unfortunately, we can't call things to the day or to the hour, and that's really why we ensure that we have diversified strategies. We understand where performance can be added in the short term through some opportunities that may persist, like quality managers that I mentioned earlier. But at the end of the day, it's all about making sure that we deliver returns for our clients, which fortunately, as we showed earlier, we've been able to do. If you have questions, please give us a call and we'd love to chat to you about those.